Hello everyone, I'm your host Vaibhav. Welcome to Wealth Visions, the podcast about public and private market investing. I sit down with industry leaders in private equity, investment banking, real estate, venture capital, and portfolio management to uncover the key factors behind their success. We discuss work-life balance, mindset, risk management, and the lessons you can apply to excel in finance and business. Today I'm sitting with Jason, who's a portfolio manager and started Hillside Wealth Management, now with over $250 million in assets under management, a reputation for outperforming the markets, and a frequent speaker at Bloomberg's Market Call. Thanks for joining and welcome to Wealth Visions. Okay, Jason, thank you so much for joining Wealth Visions. I would love to start a bit more about your background. And you initially started at UBC studying atmospheric sciences and meteorology. And you're also a CFA charter holder. Was finance the initial career plan, or how did you get into this?
The initial career plan was to do medicine. My dad's an anesthesiologist, so I grew up thinking that I wanted to be a doctor. My path in finance started when I was 15. My uncle gave me The Wealthy Barber. There was a chapter in it on compound interest. You know, Einstein calls it the eighth wonder of the world, money being able to make money. And I thought that was fascinating, and I became very interested in that. But at university, I started off doing sciences, and I quickly decided that I didn't want to do medicine. I have also a keen interest in the weather, meteorology. It didn't even occur to me that you could do a degree in atmospheric sciences, meteorology, but realized I could do that. So I switched over to that. And then during university, sort of second, third year, I was getting more interested in finance. They used to drop off the Financial Post every day at the Commerce Building. I would grab a copy. I'd be sitting in the back of my cloud physics classes studying the markets. So then I decided I wanted to do finance, and it would have been at that point another 3 years for me to switch to a commerce degree. And I just wanted to get out of university. So I finished the science degree and then started working building what is now Hillside when I was 22 years old at Investors Group.
Very cool. And you've been in this industry since 1998.
Yes.
I mean, that's more than how long I've been alive. I mean, I don't mean to call you old here, but you have extensive experience.
It's been a long time. Yeah, I'm 48 years old, and I started in this industry at the age of 22.
Very cool. And you've had more than 25 years. What are some key lessons that you've learned just overall, qualitatively, being in finance and kind of understanding who you are as a person beyond investing?
That's a great question. I mean, so the original reason that I was attracted to finance was, for lack of a better term, the sort of hunt or the treasure hunt really interested me. So you imagine there's 10,000 publicly available securities that you could invest in. It excites me to be able to identify the handful of those 10,000 that, based on my criteria, I deem to be superior investment opportunities. And I still love that today. Maybe what I've learned about myself is that, being client, so I was client facing for the first 16 years, meaning that I was meeting with clients, I was doing planning work for them as well as managing the money. And now I'm solely on the research and money management side. I found that dealing with retail investors to be very challenging. I found like I was having to almost tell little white lies all the time, or at least confirm their biases. So, a client comes to you and says, oh, the stock market's a casino. And if I said, no, that's crazy, you're wrong. The stock market is a collection of businesses, and you can choose to invest in some of those businesses or not. They just glaze over and think that you're talking down to them. And so you would have to say, oh, yes, I can understand how people will think this, and so on and so forth. And I just found that it was challenging dealing with people and their money directly. 2008 was a very challenging experience. The reality is most people haven't saved enough money, and they rely too heavily on managers to produce them outsized returns. So I was... 30 at the time, and I was having to go around talking to people who were in their 50s and 60s and say, well, your retirement, you either need to put more money in, or you're going to retire with less, or you have to retire later. And those are difficult conversations to have. So I've learned that I really prefer to be on the research and portfolio management side, and to perhaps allow others who maybe have a bit more of an empathetic personality to talk to clients, because it is really important that we do have that connection with the people that we're investing money for, so that they understand what we're doing, how we're doing it, so that they don't make silly decisions at the wrong times. And that's what most people do, in that when things are down, they panic and they sell, or when things are up, they're throwing money at stuff. They're chasing hot trends and what have you. So one of the best things that we can do for our clients is to help even out the emotions. And that's a lot easier for me to do if I'm not necessarily talking to them directly.
And you said you're primarily going for retail clients. Have you thought about going on the institution side when it comes to attracting capital?
It's not something that we've thought of up until now, although towards the end of this year, I believe that we're going to be launching a fund. Certainly the way that we manage money is very different than what's available in the Canadian marketplace. And whether the money is institutional money or retail money, we wouldn't change what we do. So from that perspective, it could be an option for us in the future. But up until now, that has not been our focus.
That's fair. I would love to get a bit more into the numbers. One of the growth portfolios at Hillside Wealth Management has yielded 19.46% return for the past year. Considering what the benchmark TSX has done, only 10.27% gain. I remember we had a conversation on LinkedIn, and you primarily alluded to the fact that we have a very simple approach. But in terms of the effort that we put in, that's really where we stand out. So if it's really that simple, why can't other people copy you? Why aren't other portfolio managers making 9 points above the benchmark in Canada?
So just a few things that I'll say before answering that. The first is that looking at a 1 year, yes, okay, we've outperformed the index by 10% in the last year. When you're looking at somebody and looking at their track record, you really want to be looking at least 5 or 10 years. If you have a track record of 1 year of outperformance, you don't really get any insight into whether or not they have a process that is repeatable, that is likely to continue to generate those outsized returns. So we have a process in place that I believe will enable us to continue to generate outsized rates of returns. And simply put, we believe in running concentrated portfolios of high quality businesses and holding those businesses for the long term. So for as long as the fundamentals continue to remain strong, and specifically talking about the return on invested capital, as long as the companies we own continue to generate strong returns on invested capital, we will hold those businesses for years. So for example, our largest position today is Constellation Software. We've held it since our inception in 2014. We've held it for 10 years. It was our number one holding then. It's our number one holding now. Now, when we identify a business that we may want to invest in, the amount of work that we do on that business is we will read all of their filings, all of their annual reports, all of the analyst calls, transcripts, et cetera, et cetera. We will then compile lists of questions. We also have criteria that we're looking for, that we have our own little form that we essentially will check off things that we're looking for. And then we will talk to the company. So we'll call up and speak with the IR or speak with the CEO or founders and ask them questions. And what we're really focused on, and so I'm getting at sort of what sets us apart, is what we're really focused on is, what is this business? What do we think, and what does management think this business will look like in 5, 10, 20 years down the road? If you listen to any analyst call of any company out there, 90% of the questions are, what are your margins going to be next quarter? What's your CapEx going to be next quarter? There are very few analysts asking questions about what this business might look like in 10 years, or how does management think about capital allocation and their competitive advantages and moats and these sorts of things. If I'm being completely honest, the reason that most people don't manage money this way. So I mean, I can talk to you, and this sounds like it makes perfect intuitive sense. Bottom-up investing, know what you're investing in, know about the people that you're investing with, who are essentially managing the money on behalf of the clients that you're investing for, and doing a lot of work. So, we don't look at analyst reports. We basically produce our own reports.
Of course.
And so the edge that we have is that we do the work. And I will also say the edge that we have is we don't think we need to own 100 or 200 or 500 or 1,000 companies. Our investable universe is probably around 100 companies, of which we own 26. But we keep tabs regularly on, let's say, 100 companies, and that's a manageable amount. if you look at, if you Google search Google search academic study on the ideal number of holdings in a portfolio from a risk management perspective,
Right.
you will find that they land anywhere from 15 to 25. Okay. We can intuitively understand that if you have a portfolio with one position, it's less diversified than if you have 2, 3, 4. Okay.
Yep.
There's a certain point, and it's between 15 to 25 holdings, where the marginal level of diversification, meaning the extra amount of diversification that you get by adding the 30th, 50th, 100th, 500th position, it goes down. 96% of a portfolio's diversification is achieved in the first 20 positions. You only get an extra benefit, and I put that in quotations because I don't think it's a benefit, of 4% by adding another 1,000 positions to a portfolio. So coming back to your question sort of about the TSX, if you look at the TSX, or even if you look at the world market like we do, there's 100,000 publicly traded companies.
Right.
The MSCI World Index, which is really what we benchmark ourselves to, at least internally, has, I think, something like 30,000 securities. Okay. The way we look at it is, out of those 30,000 securities, can we identify 20 to 30 that we think will be able to generate outsized rate of returns, so an outsized return on invested capital for 5, 10, 15. Ideally, Warren Buffett says his favorite holding period is forever.
Right.
Ideally forever. I mean, if you can find something that is going to generate a return on invested capital of 15 to 25% for you year after year for 50, 60, 70 years, that's how you get these magnificent long-term track records where you outperform the index. The other thing that I'll say is, most of our peers, they can't own 26 positions. And they can't own 26 positions for two reasons. Either number one, they're pushing too much money. So we're pushing 250 million. If you've got 5, 10, 15, 20, $100 billion of assets under management, you can't own 26 businesses. But two, more importantly, and this isn't talked about, is career risk. So I am my own boss. I work for our clients. I don't work for anybody else. I don't work for an investment committee. I don't have anybody telling me that I can or can't buy something, and I can or can't be concentrated or diversified. So there's nobody telling me what Stephen, my research partner, and I can or can't do. That's massive. Most of our peers, they do have investment committees, or they have shareholders, or they have other people that they're answering to. And if they stray too much away from a benchmark and they underperform, the leash is very short. And so you cannot, at risk of stating the obvious, you cannot outperform a benchmark if you look like the benchmark and charge 2% fee. If our clients, and we say this to our clients, if you want benchmark returns, and there's nothing wrong with that, fire us and go buy a Vanguard ETF at 5 basis points or 10 basis points. We view our roles as being able to help our clients do the right things at the right time. So we talked about behavioral coaching. We talk about financial planning, which is very important, and also generating returns over and above the benchmark and over and above our fees. We need to add value on the investment performance side of things. And that's why we have a clear focus at Hillside, where there's myself and Stephen, who only do research and investment management. So those are some of the reasons why not everybody can do this and be successful at this. Some of it's structural, some of it's sort of cultural.
And what's your view on active investment, active managing securities? Because primarily from what you do at Hillside Wealth Management, what you have been doing at Hillside for the past 20 years, you have a concentrated portfolio, you're investing in what you know, you're looking at all the data, you're understanding the market economics, you're understanding how a business works at a very personal, deeper level, which, exactly what you said, gives you the edge. What do you say to people who want to actively manage portfolios and want to constantly be going in and out of trades in like a 3-4 month time period, which is so-called the sweet spot when it comes to the professional trading industry?
So if you look at, there's rankings in Canada, there's SPIVA, S-P-I-V-A, that ranks mutual fund managers, and something like 90% of active fund managers don't outperform their index. And that underperformance is particularly prevalent in Canada. In places like the States, it might be 80%, but everywhere in the world, it's well over 50%, and it's much closer to the 100% than it is to 50%. So first of all, what we are doing is very difficult. Only 10% of our peers are effectively able to consistently outperform the index. So we are told constantly that what we're doing is impossible and that we're going to fail and that we're going to blow up. And there's a lot of people directly who say this to us, indirectly who say this to us. The entire passive industry is set up to essentially take money from people who are active investors such as ourselves. If you look at, I think in the States, there's greater passive share than there is active share now. I think it's something like 60-40. In Canada, we're getting close to 50-50. I believe that prevalence of passive investing can distort things and provide opportunities for people like us. So when you're passively investing, you're blindly buying what's in the index. So if you put $100 in the S&P 500, you have, whatever, $2 in Apple, $1.50 in Microsoft, et cetera, et cetera, et cetera, et cetera. And you're kind of at the whim of the index. Let's say Tesla comes out with absolutely horrendous earnings tomorrow, or whatever, there's some sort of long-term structural thing against, let's say, a newspaper as the internet comes out, you're still blindly buying that index. And it can have some unintended consequences, which we may or may not see going forward. But the reality is, so Warren Buffett says that index investing, buying an index, and when you're buying an index, the biggest name of the game is finding the cheapest provider of that index product, is appropriate for 95% of people. And I would say I agree with that. Mm-hmm. If you want to learn how to identify securities, and you want to do the work, and you have a good level head, and you have the ability to construct a concentrated portfolio of high quality businesses, there are opportunities there to be one of the 5 or 10% that are able to outperform. And so we are choosing the difficult road. I mean, most of our peers will take mutual funds or ETFs and put that in client portfolios. We only own individual securities. If it doesn't go well, there's nobody. We don't blame anybody else. It's us. We are the ones doing the work, choosing the stocks to hold in the portfolios, and so we're accountable to that. We can't point to AGF and say, oh, well, this fund's done bad, so let's sell it and buy something else. And so we choose to essentially put ourselves in a position with greater career risk and accountability. But we think that the rewards, which are namely that our clients are achieving great returns and able to achieve their financial goals, and of course Hillside grows because of that, we think that it's certainly worth the effort.
Yeah, you briefly mentioned risk. I would love to get a bit more into what you mean by that. What do you mean by risk? What you mean by volatility? What you mean by economic uncertainty? And what do you do to manage all of that risk? Are there certain valuation metrics that you're running, or certain statistical programs that you have in the back? What does risk mean to you?
It's a very, very good question. So risk for us is permanent loss of capital. So what we mean by that is, when we invest in a business, what are the chances that essentially the end result is zero? You're left with nothing. So we spend a ton of time thinking about risk, and quantifying risk, and thinking about worst case scenarios. So when you're running a concentrated portfolio of 26 businesses, you can't really afford to have one kind of buried in there that just does poorly, right? So, and then on the upside, right, if you have 500 positions in a portfolio and you have one that does very well, it barely moves the needle, right? So we've talked about why you want to run a concentrated portfolio. But when you're running a concentrated portfolio, you need to be even more certain and have higher conviction than if you're running a 1,000 position portfolio. So first and foremost, we almost exclusively only invest in businesses that are founder run, founder owned. And the reason for that is simple. We want to invest alongside people who also are owners of that business. If you look at a company that is professionally managed, the incentives for those managers are wildly different than a business that is founder run, founder owned. You're professionally managed, and I'm making stereotypes here, but your professionally managed business, the people in the C-suite they're looking to climb the corporate ladder. I mean, unless they're at Apple, if they're at $1 billion company, they want to be at a $10 billion company. They want to be at a $100 billion company. And the quickest way for them to get from $1 billion to $10 billion to a $100 billion company isn't to grow it. It's to jump ship, right? Move around. So we typically find that founders obviously stay with the companies. They typically think and behave with a long-term mindset because they're not necessarily looking to jump ship or get a bonus or what have you. And they behave like owners because they're owners. So we believe that one of the ways that we're able to reduce risk in the portfolio is by partnering with people who have a stake in the business. We are partnering with them. We're not essentially giving them money well, we are giving them money, but you know what I mean. Another way that we think about risk is we hate debt. Like, I mean, hate it. Now, we do have some businesses in our portfolio that do have debt. But I would say that we are very uncomfortable with any business that has a debt to cash earnings ratio of greater than 3. We much prefer it to be around 1. Or, I mean, if you think about it, the very best businesses business models in the world don't use and don't require any debt. So by limiting our investable universe to businesses that only have strong balance sheets, that reduces the risk. Another way that we reduce risk is we almost exclusively invest in businesses that have a high repeatability nature to their business operations. I'll just give you an example. So RH, Restoration Hardware, they sell high-end furniture. How many $10,000 couches are you going to buy in a given day, month, year, or lifetime? Versus, say, Coca-Cola, right? They're selling cans of Coke literally every second of the year. So we like companies that have high repeatability to their business operations, high recurring revenues. So we're looking at companies where their customer churn rate is in excess of, less than 10%. So they're retaining greater than 90% of their customers on a year in, year out basis. We have a company in Norway, it's a consulting company called Bouvet. They just came out with earnings yesterday, and 96% of their revenues from the quarter were from existing customers. So we like businesses that have stable customers who buy from them frequently. And so that's another way that we reduce risk. I mean, I can go on and on. Another way that we reduce risk is we favor capital light business models. So if you think about an oil exploration company, the amount of money they have to spend to find the oil, then get the oil out of the ground, and then get the oil to market. And then when they get the oil to market, guess what? They have no control over the price. The price is what the price is. That's a horrible business model. Now let's think about, I don't know, Meta. Meta's a website. Yes, they have 70,000 engineers, and yes, they're throwing $10 billion a year at the metaverse or what have you. But at the core of Meta is a website or websites, Instagram, WhatsApp, and Facebook. And they don't necessarily need to spend a lot of money to maintain those websites, add new users, add content, so on and so forth. So we look for companies that are CapEx light, so they don't spend a lot of money to make money. The very best business model in the world is one that is able to grow their revenues and profits without additional capital. And then once they have that capital, this is another way that we reduce risk, we like to see evidence that they do smart things with that capital. So out of the 26 businesses we own, they all are producing positive earnings. And so what do they do with those earnings? They can reinvest in the business, they can do M&A, they can pay a dividend, they can buy back shares, and so on and so forth. So we like to see evidence of them making intelligent decisions with the excess capital that they generate.
Definitely. Since we're on the topic of portfolio management and we spoke a little bit about valuation, I think this conversation would be incomplete if we didn't talk about the human behavior that drives financial markets and drives valuations and drives people's behaviors, their psychology of what they want to invest in, considering what the economy is doing, considering what the industry is doing. Yeah. So in terms of that, what are some good behavioral traits you would say someone needs to have if they want to get into this industry?
So Warren Buffett, when he's asked about macro stuff, so interest rates, inflation, geopolitics, and I didn't understand this till about 10 years ago. I mean, I understood it, but I didn't really understand it. He would just say, listen, it's irrelevant. I have no control over it. I'm not going to pay attention to it. And we are now of that mindset. And it hasn't always been that way for us. But here's the easiest way for me to explain it. So, and it all comes down to time horizon. If you're investing with a 1 or 2 year time horizon, then yeah, I guess whether Trump gets in or Harris or Trudeau or interest rates or inflation, maybe those things matter. But if your time horizon is 10 years, 20 years, 30 years, which is the way that we think and behave, in those 10, 20, 30 years, you're going to have high inflation, low inflation, high interest rates, low interest rates, calm geopolitical backdrop, active geopolitical backdrop, and everything in between, recession, expansion, all of it. So we accept that all of these sorts of conditions are going to happen. And the first thing that the first way that we think about this is, number one, we want to invest in business models that can not only withstand difficult economic situations, but the very best business models excel during periods of economic uncertainty and challenges. So you talked about, I think you raised the behavioral traits. Now, and this is one of the reasons, the main reasons why it's a huge advantage for us to have myself and Stephen not talking to clients. Every so often, I'll talk to Mike and Amanda, who are client-facing people on our team, and I'll say, what are clients saying? Just give me a sense for what's going on. But for example, in 2022, when the markets were down 25%, our clients were probably freaking out a little bit. They're nervous. They're getting emotional. This is normal. They're looking at their statements. It's going down, I don't know, 10,000 a month or whatever the case may be. If I then all of a sudden I'm getting phone calls and emails of clients who are frustrated, annoyed, don't really understand what's going on, maybe they're lashing out, it cannot not affect the way that I manage money.
Absolutely.
Okay. When I don't want to say the retail investor, when the average investor is freaking out the most, that is when maximum opportunity exists. Right. That's when you want to be on your front foot, head down, blinders on, your plugs on so you're not hearing the noise. And that's when you want to be checking your notes, checking valuations, and then deploying capital. When everything's going well, like right now, everybody's happy. I don't want to say I'm everybody's best friend, but when things are going well, that is the time where maybe you want to be a little bit on the back foot, a little bit cautious and defensive. So, I don't think we're necessarily there yet. I've seen crazy, like I saw the tech bubble from 98 to 2000. That was manic. We're not anywhere close to that. Maybe on the AI front a little bit, feels very frothy, but where we have been able to add significant alpha, and so alpha in investment management is outperformance, where we've been able to add significant alpha has been during these periods of times where either the market as a whole has a freak out. So for example, March 2020 with COVID, or all of 2022 with the uncertainty of rising rates, long dated assets. So growth stocks, which we typically find ourselves in, are long dated assets. They got bid down because rates were rising. And so you could have, you could get 5% in the GIC. We understand all that. Yeah. So those are the periods where the forward rate of return. So when the price of what people fail to understand is when the price of an asset, with the caveat being that it's a high quality asset, meaning it's not going to zero. When the price of a high quality asset, in this case, public securities, falls 20, 30, 40, 50%, if you are a long-term accumulator of wealth, you should be partying. That is time to dance and celebrate the fact that you have the opportunity to buy high-quality assets on sale. And so that's what we did during 2022. That's what we did during 2020. It feels uncomfortable because you're going against the masses at the time. But I can assure you that if you've done the work and your assessment of the asset is accurate in that it is in fact a well-run, high-quality investment, that's where you will generate superior returns.
Yeah, it's very clear that family definitely plays a very big role in how you work and how you live. And we also talk about wealth in terms of finances. Mm-hmm. And my question is, what does true wealth mean to you?
Freedom. So I mentioned one of the three instances of Hillside: family, freedom, and performance. So we talked about family. We've talked a fair amount about performance, how we drive that performance. And then freedom. So the freedom bit for us really speaks to our ability to live our life the way we want to live our lives, and also for our clients to be able to have the freedom to live the lives that they want to live. the lines between sort of work, volunteering, play are kind of blurry these days, right? 50 years ago, right, you had a job, you worked at it for 40 years, you retired, you played golf or whatever, right? Nowadays, so we're in the retirement planning business, essentially, right? If you really love what you do, so I love what I do. I have zero, for me, retiring, if I retired tomorrow, I would just be managing my money the way that I'm managing my money now and managing money for other people. So the concept of retirement for me means nothing. I would love to be Warren Buffett, Charlie Munger, have my mental facilities with me and doing this when I'm 95, 99 years old. But you and I are having this conversation at our cabin on Boyer Island in Howe Sound. I have used essentially the wealth that I have created to have the type of lifestyle that I want to have. I don't need a private jet. I don't need to live on Point Grey Road. I'm happy living in East Van, and I'm absolutely thrilled to have the ability to own this cabin here in Howe Sound and spend lots of time doing it. So I love fishing, prawning, having friends here, cooking, making sushi with my kids, spending time with our kids. We have 4 kids, so the school year for us is absolute chaos. So this time that we get to spend here at our cabin in the summer is really great for my wife and myself and our family. The ability to travel, the ability to send our kids to university and have the opportunities that they want to have as they grow up. That's what freedom means to me. And also, on the professional side, as I mentioned, I don't have a boss. We don't have people telling us what to do, when to do, how to do it. And so we have, I have a tremendous amount of freedom in my life, both on my professional side and personal side. And wealth has enabled me to have those privileges. And that's, quite frankly, was really the goal from when I was 15 years old, was to become financially independent, first from my family, and then for myself, and then to be able to enjoy the fruits of those labors. But, I could retire tomorrow, but I have absolutely zero interest in doing that.
And, being where you are and having achieved so much, what do you hope to pass to your children, both in terms of financial wisdom or life lessons? What does that mean to you?
That's another really good question, and something that I think about actually quite a lot. So first and foremost, my wife and I believe that we want our kids to be kind and curious. We want them to be kind to all of the people around them, and we want them to have a curious mind. You had a question earlier about what are some of the traits that I see that would lead somebody to be successful at doing what I do. Curiosity would maybe be at the top of the list. The curiosity when you hear something, like my kids will come to me and tell me, "Oh, Daddy, there's a study or I heard on TikTok that up to 3 hours a day of screen time is good for you," and I'm like, I think that's garbage. But I immediately go online and I start looking at studies and see where this information comes from and see whether I can actually shoot that down or, crawl to a corner and accept that 3 hours a day of screen time is good for them. Yeah. And so we would love for our kids to be curious. We would love for our kids, we tell them often, we don't care what you do when you grow up, and you don't even need to know what you want to do when you grow up. They're 6 to 13. Certainly they don't need to know that. But when you do find something that you love, and we hope that you find something that you love, that you do it to the best of your ability. You try to be the absolute best at whatever it is that you choose to do. That's a message that doesn't get communicated a lot, especially in the education system today, where exceptionalism is kind of beat down. 3 years ago, one of my kids came to me and said, "Hey, Daddy, we want to buy stocks." And I said, "Oh, that's great. And do you know what you need to do to buy stocks?" He was like 9, talking with his friends. They're probably watching some TikTok stuff. And he said, "No." And I said, "Well, you need money." "Okay, well, how do I get money?" I said, "Well, if I were you, I would start collecting cans and bottles." So this was 3 years ago. So we created, they have a logo, they have a name, they're called the Salty Seals. And they started collecting cans and bottles in the city. Now they're collecting cans and bottles on the island here. And 2 years into it, they sent packages to the neighbors with a little plastic bag with a little note saying, "Hey, we're the Salty Seals. basically telling the story that I've just told. And we make sea salt here in the winter. So we take buckets of water out of the ocean, we evaporate it, and we create salt. And so they give little packets of salt to say thank you. And so they're learning how to essentially communicate with people. They're learning how to be entrepreneurs. I explain to them, when there's somebody, one of your customers is drinking a beer, you're making 10 cents. You could be asleep. We could be on vacation. You're making 10 cents. So they then take that back. They have now returned 40,000 containers. They're at $4,000. And they own 4 stocks. So they have now bought shares in the companies that essentially we invest in for our clients, and they're starting to learn about those companies. And slowly they start asking, they'll surprise me with questions. I mean, all of your questions have been excellent, and they'll sometimes ask me some really interesting, unique questions where I kind of get excited, because it indicates that they're thinking the way that somebody who might be allocating capital would think. And it would be great if 1 or 2 or all 4 of them were to do what I do, but we put obviously no pressure on them to do that. So yeah, that's one of the ways that I'm helping them understand money, growing money, investing in businesses, and quite frankly, hard work. So yeah, that's the way we raise our kids.
Do you ever think of when you were young, you had received these lessons from your parents, perhaps? And were you in that position to receive that kind of, I should say, mentorship?
Yeah. Okay. So I have a working theory that people's money habits are learned very young. One of the questions that whenever we talk to a founder or CEO, I will always ask, did you grow up in a spend first or save first household? Because I'm always interested in learning how people have essentially grown up with money. So my dad was born in Italy, came to Canada when he was 10 from Italy. My mom was born in actually South Africa, but to English parents. And so she came also in the 50s. And so they're like first generation Canadians. Certainly my dad's family, my dad's parents had like a grade 3 education, were essentially farmers from Southern Italy. And he went through university, got his medical degree and practiced as an anesthesiologist. And so I grew up in a really upper middle class or upper class household. I went to a nice private school. I had all sorts of opportunities in front of me. But what was interesting is, as we were growing up, is the things that my parents spent money on were not the same things that my friends' parents spent money on. So my parents had no problem spending money on anything to do with music, sports, education for us. So piano lessons, violin lessons, squash lessons, et cetera, et cetera. There was never any issue with that. And so we were fortunate, obviously. But that's where the buck stopped. And I mean stopped hard. So my mom's grandfather was a Scottish engineer. Like, they don't get any cheaper than engineers and Scottish people, okay? He would, rather than buy Band-Aids, he would tape his cuts with masking tape, cheaper.
Wow.
He would so milk used to come in bags. Mm-hmm. Okay, we used to take those bags, and that's where and our lunch would go in those bags.
Wow.
We would go to school with sandwiches wrapped in wax paper. And my mom would be pissed if we came home at the end of the day and didn't have the wax paper to be able to wrap the next day's sandwich in it.
Wow.
Like, it makes me, if I earn $1 and I spend more than that $1, I literally get physically ill. Like in a casino, I'm ill in a casino. I cannot understand the concept of gambling where you are placing a bet where you know the chance of you winning is less than 50%. It makes me sick. And that was just pounded into us as kids growing up. So we grew up in a affluent household, but for sure a save first household. Mm-hmm.
Just have one last question. So let's say that someone is 20 years old and they're listening to this podcast and they want to get into finance. They maybe have hopes of wanting to start their own hedge funds. Mm-hmm. What's the advice you would give them?
So this is going to sound corny, but it is 100% true. If you are not passionately interested to the borderline obsessive about security analysis and investing, then I would say don't bother. Like if you just want to get into finance because, I don't know, you think you're going to make money, or you see people in suits, or you have relatives or whatever, and they make it sound like it's wonderful. This doesn't even have to do just with finance, like anything, medicine, teaching, whatever. Like if you're not interested, and I mean, at least in my case, in love or passionate about it, you're not going to do very well.
In the actual work.
Right.
Not just how it looks like, but the things that you're doing.
Correct. So, Warren Buffett says something like, it's never been about the money. It's just that in this business, the scorecard is money. So like for me, up until a certain point, it's not really about the money. It's about generating exceptional returns and giving our clients exceptional experiences. And if we do that, yes, we will make lots of money, and that's great. But if you go at it, and many people, I see tons of people in this industry, if you go at it with the I want to make money for me first mentality, you're going to fail. You might have regulatory or criminal issues, or at the very least, you're just not going to enjoy it. I would say, so I would also say that, so getting to, for lack of a better term, being a value investor. So when you're looking at individual securities and you're thinking about it from how to allocate capital and generate returns on that capital, you're not going to learn much about that in university or even in the CFA program. In fact, I think that traditional financial education is a net negative than a net positive for the people that go through those experiences, because they get fed all sorts of stuff that
practicality.
Right. So if you want to become interested in generating significant long-term wealth, which in my opinion entails running a concentrated portfolio populated exclusively with high-quality stocks bought at attractive prices, you're going to need to study people who do this. The fortunate thing is that there are two of the best who have ever done it, Charlie Munger, who just recently died last January, and Warren Buffett, who have written an annual letter since 1962 through the Berkshire Hathaway President's Letter. Read every single one of those. Then go and read every single one of the President's Letters that Mark Leonard from Constellation Software has written, and start to study these people. So study people who have generated, let's say, greater than a 15% compound rate of return for at least a decade, preferably 2, 3, 4 decades, and look into what they've done and how they've done it. And you're going to start to notice a bunch of commonalities. Concentrated portfolio, high quality businesses, not trading in and out of businesses, not caring about what the macro backdrop is, and you'll get a feel for that. And if at the end of that you're still super pumped, which I was, then I think you have a very good solid foundation from which to grow.
Well, Jason, it's been a pleasure to make your acquaintance. Thank you very much for the invitation at your cabin. And, it's definitely been a learning journey for me as well. And I'm sure that our listeners will be able to get a few very strong gems out of this listening session. So yeah, thank you very much again for your time. And I suppose we could do this again in the near future and see where it goes from there.
Absolutely, my pleasure. And thanks for having me on.